And it may be a while, but you just made 16% in 1 year on the long-term bond. Be delighted you made that. 16% on something that's considered relatively safe and secure is great. But if other countries of the world start getting their stuff together, those bonds could fall quite a bit. If U.S. interest rates go up 2 percentage points, well, let's just do 1 percentage point. The long-term bond fund has what's called a duration of 15%. If interest rates go up 1 percentage point, just that factor alone will drive the value of that bond portfolio down by 15%. That may not happen in the next 12 months. It may take 2 years. But if our economy starts to get going and Congress actually passes some kind of bill to improve roads and bridges and there's a significant increase in spending and the economy gets going, interest rates will go up. That's just how that works. And you could lose 15%. If they go up 2 points, you could lose 25 to 30%. If people find somewhere else in the world that they want to invest, France, Germany, they change their mind about Japan or find some other country they want to invest in, those bonds can go down a lot. So that's one thing that I see in this June 30th data. Another thing I want to look at is U.S. stock market. Now, regular listeners to my show know that I call it the U.S. market matrix, and I break it up into 6 different segments if your portfolio is big enough. If you only have $10, $12, $15, maybe even $20,000, you should just put it in the total stock market index and forget about it, because trying to rebalance is not going to gain you a whole lot, and it's a lot of time and effort and work on your part, but you could do it. But here's the results for the total stock market index as measured by the Vanguard Total Stock Market Index Fund, Admiral Shares. The symbol is VTSAX, in case you want to look it up. The current yield is 2%, and in the last year it made 2.14%. And the last 3 years, it's returned 11% per year. In the last 5 has been 11.6% per year, and the last 10 is 7.5% per year. So this is something that you could do a quick look at your portfolio. If your portfolio is primarily in the U.S. stock market and it's performing below these numbers, you should ask yourself why. Now, recently I was talking to a client that has a large portfolio, and they have a broker that keeps buying and selling stocks for them. And apparently the trading costs are free, which I'm still dubious about, but even if they are, they're paying 1.5%. And over the last 3 years, when the market has made 11%, they're making 3%. And that is not counting the tax consequences, because if they're in a taxable account. If you're trading, tax consequences are much higher. We've also talked about that recently. So look at your portfolio. You should get a statement from June 30th. You should get it by the time you're hearing this show, or a day or two afterwards, somewhere around July 5th or 10th or 12th. Look at those statements and look for an annual performance number. It might have year to date, which we're not talking about. We're talking about 1 year. You want to look at 1 year, 3 year, 5 years, 10 years if they have it. If it doesn't put it on your statement, which is likely, go look at past statements. Go online and see how you're doing. If over the last 3 years you're making, give or take, around 11, 12% in your portfolio, at least the stock market part, great. You're doing fantastic. But this is a way to look at it. The other thing that I look at is the 10-year number is 7.54%. The long-term trend is 10.47, at least as measured in the last 46 years by the S&P 500. And the even longer-term trend is around 10%. 7.5% isn't sending off alarm bells for me. So this is not like when I started with the story earlier in the show, where we had 23% to 37% per year for 5 years. This is not what has happened in the last few years. So could the market drop 25% right after I put the show out? Yeah, sure. Anything's possible. But you're a long-term investor. It doesn't look like it's overheated by these measurements. I'm not particularly worried. And I'm a long-term investor, so I want to stay in because I don't want to miss the upside. Most people underperform, not because from time to time their investments go down, but because they don't make the money when the market goes up. And now we're going to look at some of the segments that I do. And like I said, if the portfolio is large enough, and we're talking about 200, 250,000, you might have money in large cap growth and value, mid-cap growth and value, small-cap growth and value. Those are the 6 different positions. And sometimes they're market neutral, so that they're in proportion with what the market is. And sometimes they're adjusted. So if something is particularly underperforming, I might put an overweight in that. One of the positions that I'm currently overweighting, and it looks like I'm going to continue doing that, is the large cap value position. And in part because it's underperformed slightly over 3 years, and it's done all right over 5 years. But in 10 years, while the total market has made 7.4, it's made 6.4. So it's lagging by 1% a year over the last decade. That means, at least in my mind, slightly less risk and slightly more opportunity. We're not getting crazy and taking all of the $250,000 that your portfolio might have and putting it in this one position. We're simply overweighting it in relationship to the neutral position. The other thing that I've noticed in particularly the last 3 to 5 years is that small cap growth has underperformed. And in the last 3 years, the total market has made 11%, but small cap growth has returned 7.43%. The small cap value has done okay, and it's in the hunt, and mid cap has done fine. But this one position of the 6 is materially behind by 3.5 percentage points. So that, again, is a sign to me that there's an opportunity there. However, when you look at the total 10 years, it's in the game just like everything else. So this is kind of a short-term thing for me. Short-term for me is 3 to 5 years. So in the last 3 to 5 years, this position has underperformed. It actually significantly underperformed in the last year. So small cap growth, at least as inside of a Vanguard index fund, now seems like someplace I might overweight compared to the neutral position. So most of the things are in the ballpark, and depending on the size of your portfolio, you can break it into, you can have one piece, the total stock market, or if you have a larger account, all 6 pieces, and then we can make adjustments there. Another segment of a balanced portfolio might include things like REITs, real estate investment trusts. And I've talked about them all the time. You must have publicly traded REITs, or you must have a mutual fund that has publicly traded REITs. My preference, not surprisingly for the regular listener, is the Vanguard Real Estate Investment Trust Index. And over the last 10 years, it's made 7.6%, so very similar to the U.S. market. In the last 3 and 5 years, it's 12 and 13%, pretty good. But here's the one that is surprising to me, and I had to double and triple check this. In the last 12 months, the Vanguard Real Estate Investment Trust had made 24%. That is amazing. It is expected in the really, really long run, 10, 20, 30 years, to make about what the stock market makes. But it's made 24%. So that's something to keep an eye on as a potential concern. Now, I'm not saying run away from this fund, but usually for real estate investment trusts, I keep it around 10, maybe 15% of your portfolio. If it has done really well for you in the last 3 to 5 years and it's now gotten a little ahead of itself, if it's 13, 15, 18, 20% of your portfolio because it's done better than other segments, you might want to consider trimming it. And if you are already in the retirement phase, and we've talked about this on recent shows as well, this is where you want to take a good chunk of your money out for this year. This is where, if you're taking out money monthly, quarterly, or annually, you want to take money out of the places that have done really well. We already talked about earlier in this segment, if you have long-term or intermediate-term U.S. bonds, I would be taking money out of there. I think I'd be taking all the money out of there. This one I wouldn't be taking all the money out of, but you might want to consider about that being a great place to take money out while the U.S. market is, at least in the last year or two, kind of soft. You don't want to take money out when it's flat or negative. You take out money out of the things that have gone up. The next thing we have is the total international stock market. And again, these are numbers from the Vanguard Total International Stock Market Fund. In the last year, it's down over 9%. For 3 years, its average return is about 2%. For 5 years, it's 0.5%. And for 10 years, it's 2%. This is one of those things that advisors often recommend that you have a generous portion in your portfolio of international. And we talked about a few weeks ago Vanguard target date funds, which may have as much as 30% of your money in international. And Vanguard has been saying for many years, and if you look at 100 plus years of data, having between 20 and 30% in international creates an optimal point where you get the best return versus risk, i.e. volatility trade-off. And so 30% for me seems on the high side, but it's not unreasonable when looking at the total long-term data. Thankfully, for the last decade or so, I've had most people around 10% in this position. Some a little lower, some a little higher, and you don't want to get too nutty with how finely you slice this stuff. But it has done so terribly in the last 10 years and 3 years and 5 years, and even worse in the last year. And I'm sure the Brexit didn't help it any. It probably drove it down some in the last few weeks. I am now starting to increase the amount of money I'm putting in international. So that gives you a little bit of the thought process in my head. Yes, it's terrible. It's absolutely horrible. And if you look at some of the worst funds that you could buy, you're probably going to find some international funds. I'm not saying any random international fund, but if you've got 10% of your money in international, you might want to start increasing it. And again, these are like in context, small moves, Ellie, right? You're going to go from 10% to 12% or 14%. And you might do that with new money that you're adding in. You don't necessarily have to sell something to get into it. Of course, if you have those long-term bonds, you might want to think about doing that depending on how you are doing with your cushion. But this is something I'm now leaning towards increasing. So if you've got 10, you might want to do 12. If you've got 12, you might want to do 15. If you've got 15, you might want to go to 20. So something to think about. The same kind of guideline goes along with emerging market stock fund. It has done just about as poorly in the last 5 and 10 years, and definitely worse in the last couple of years than international. Emerging markets are the really small countries around the world, not necessarily small by population, but small by economic power. Laos, Bangladesh, maybe Venezuela or Uruguay, different countries around the world that are small, and they tend to be much more volatile. They've done poorly. So I'm kind of interested in that. And that bias may change depending on how far you are from retirement. So someone who's 30 years old, well, maybe we put even more in international and emerging markets and see what happens. It's a bit of a risk. It's a gamble. It may not pay off. But we've also had a case, I think it was 2005 or 2006, that the emerging market index went up 70% in 1 year. So don't even think about putting all your money there, but you might want to wait a little bit more into international and emerging markets. So that's some thoughts on that, and I've gone even longer than what I wanted to do. So hopefully you could keep up with the math in the podcast. I always worry about that, and people tell me I shouldn't, but thank you for listening to all that. Of course, if you want to discuss your situation, which may not apply to any of the stuff that we've talked about, you can email me, phil@polarisfinancialplanning.com. And if you do, please be so kind as to send your phone number so I can call you and have an appointment. I do love when people send me emails with lots and lots of detail and data, but it also kind of spooks me a little bit because you haven't even checked that you sent the email to the right place. So you can send me some information. Don't get nutty, but send me your email or your phone number because we're going to want to talk. So that's a way you can get some more information and input from me specifically on your situation. So I'm going to wrap that up. We're going to do a little quick commercial break, and then we're going to go into our interview and talk about street epistemology. This is Phil Ferguson with Polaris Financial Planning, the home of science-based investing. I see people owning really bad investments all of the time. Many advisors are paid a commission by a big company to sell you something you may not need. It's kind of like church. They create fear, then they tell you what you want to hear, and then they take your money. What you want is an advisor that is paid only by you. That is a fee-only fiduciary advisor. Remember, people work for who they are paid by. You can contact me, Phil@polarisfinancialplanning.com, or listen to the cleverly titled The Phil Ferguson Show. Each show, we have an interesting investing skeptically topic and an interview with someone fighting to end religion. Polaris also gives 10% of gross revenue to support the growing secular movement. You're not just getting better investments, you're helping